coming week will see the great and the good gather in Davos, Switzerland for the latest World Economic Forum. The event runs from the 20th to the 24th of January, and the theme is Collaboration for the Intelligent Age. Make of that what you will, but I'm sure there'll be some very happy Swiss restaurateurs and hoteliers come the end of the event. Back home, corporate news flow will remain steady in the form of Christmas or year-end updates, with Primark owner Associated British Foods and Burberry names of particular note on Thursday the 23rd and Friday the 24th, respectively. On the other side of the Atlantic, the fourth quarter reporting season will really start to hit its stride, with household names such as 3M, United Airlines, Procter & Gamble, Intel, Texas Instruments, and American Express all scheduled to release their results for the final 3 months of 2024. However, the biggest names report in the coming week in terms of market capitalization and its effect upon wider market sentiment, both in the US and overseas, worldwide, is Netflix. The streaming giant is due to publish its fourth quarter and full year results on Tuesday, the 21st of January, and we will be focusing on this one in this week's video. With a $375 billion stock market valuation as I sit here, Netflix is the 25th most valuable public company in the world and the 21st largest in North America. For all that, it isn't seen as one of the so-called Magnificent Seven grouping, which comprises Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, even if Netflix used to be one of the FANG quintet, when that lot were all called, as they were then, Facebook, Apple, Amazon, Netflix, and Google. Netflix got shunted out back in 2022 when it doled out some disappointing subscriber growth numbers. Interest rates rose and the share price fell by 2/3. In a trend that may tell you how useful, or otherwise, catchy mnemonics and marketing tags are, Netflix's shares promptly more than quadrupled as it got subscriber growth back on track and generated substantial improvements in sales, profits, and cash flow as a result. The shares have actually been weak in the past month, hampered as much by rising US Treasury yields and the weight of expectations as much as anything else, given that the stock trades around 35 times consensus earnings estimates for 2025. Analysts and shareholders will therefore look to these fourth quarter figures for 2024 and any guidance for 2025 for reassurance. In terms of the headlines, analysts expect fourth quarter sales of $10.1 billion, up 15% year on year. That would take the full year total to $38.9 billion, also up 15% year on year. And fourth quarter earnings per share of $4.21. That's up from $2.15 a year ago, but down for seasonal reasons from the third quarter. That will take the full year total to $19.76 if achieved, up from $12.03 in 2023. Should co-chief executive officers Greg Peters and Ted Sarandos update prior guidance for 2025, the current analyst consensus is as follows. First quarter sales of $10.6 billion, that's up 13% year on year, with earnings per share of $6.07, up from $5.40 in Q1 2024. And full year sales of $43.7 billion, that's an increase of 12%, with full year earnings per share of $23.83, that's up by more than a fifth. After that, analysts will switch to some of the details that drive these figures. Now, Netflix no longer gives specific guidance for quarterly net subscriber adds, although co-chief executive Greg Peters and Ted Sarandos did suggest at the fourth quarter stage, fourth quarter net adds would exceed the 5 million gained in Q3, thanks to usual seasonal trends and also they feel is a strong content schedule. Netflix ended the third quarter with just under 283 million paid memberships, and that's up from 167 million in the fourth quarter of 2019, just before COVID broke out and we were all confined to the sofa for large chunks of 2020. Netflix doesn't provide guidance for average revenue per member, or ARM, either. And from the first quarter of 2025, the company will cease to publish quarterly membership and ARM numbers, at least if prior promises are anything to go by. Peters and Sarandos argued that revenue, profits, and cash flow are now better indicators, given Netflix's greater maturity. In addition, there are new growth levers in the business, beyond just subscribers and pricing, notably advertising, additional features, and varied price and membership tiers. So viewer engagement is now a greater focus than just net adds and subs numbers. All the same, average revenue per membership has generally started to flatten a bit, perhaps as a result of the new business models and segmentation. However, cash flow continues to blossom, with the result that net debt before leases and content purchase obligations is $8.5 billion, and that permits Netflix to invest in ongoing content, technological development to cement its competitive position, and fund share buybacks. Netflix bought $1.7 billion in stock in the quarter to take the total in 2024 to date to $5.3 billion, with the last 3 months to come. And that lot compares to 2023's grand total of $6 billion. Remember, Netflix does not pay dividends. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.